If you keep bleeding money in the markets, it's probably because you're blind to the one signal Richard Wyckoff called the truth teller of every trend, volume. Picture this: a stock drifts quietly downward, retail traders panic sell, and suddenly, out of nowhere, massive volume spikes at the lows without any real price progress. Most traders think it's just volatility. But Wyckoff would lean in and whisper, "No, that's Composite Man absorbing every last share before the markup." Days later, price explodes upward, leaving the crowd stunned while the professionals ride the move they quietly prepared for. The secret: that abnormal surge in volume with no downward continuation. Wyckoff's hidden sauce reveals the moment smart money shifts from selling to aggressive buying. If you can read that one signal, you stop losing money and start anticipating the SEO price shifts before they happen. Ladies and gentlemen, today we are stepping behind the curtain of the financial markets, into the shadows where the Composite Man moves, plans, and profits long before the public even senses a shift in trend. Most traders lose money not because the market is unpredictable, but because they fail to recognize the silent footprints left behind by professional operators. Richard Wyckoff dedicated his life to decoding those footprints, and among all his discoveries, one signal stands above the rest: the volume shift that exposes exactly when smart money is preparing for a major price move. In the next few minutes, I'm going to show you how this single pattern, often overlooked, rarely understood, can reveal accumulation, distribution, and the explosive reversals that follow. If you've ever wondered why you buy at the top, sell at the bottom, or always seem one step behind the market, this is your turning point. Because once you learn to read Wyckoff's secret volume clue, you will never see a chart or your trading results the same way again. A Wyckoff volume climax is one of the most revealing and decisive signals in the entire Wyckoff methodology, and understanding it can instantly elevate a trader from guessing to interpreting the true intentions of the market's dominant forces. Wyckoff believed the market has a personality, one shaped and controlled by large operators who accumulate and distribute positions long before major price movements occur. When these professionals step into the market with size, they leave behind an unmistakable footprint, a dramatic spike in volume at or near the end of an existing trend. This is the moment the crowd misinterprets as panic, breakout strength, or trend continuation, while the Composite Man uses it as a strategic opportunity to reverse the market's direction with precision. A volume climax typically marks the exhaustion of one side of the market. At the top of an uptrend, a buying climax occurs when the final surge of retail buyers, motivated by excitement, fear of missing out, or news-driven enthusiasm, pushes price upward aggressively. Professional traders, however, are not buying with them. They are selling into this euphoric burst of demand, handing off their large positions to retail buyers at premium prices. The chart shows a long candle with exceptionally high volume, but what matters most is what comes next. Price fails to follow through upward, signaling that demand was temporary and artificial. From here, the Composite Man quietly begins weakening the market through distribution, initiating the beginning of a bearish trend. On the flip side, a selling climax occurs at the end of a sustained downtrend. Retail traders panic, forced sellers liquidate positions, and social sentiment plunges into despair. To the public, it appears the market is collapsing. To professionals, this is the perfect environment to accumulate shares at discounted prices. The candle often forms with a deep wick or a sharp reversal intraday, and volume explodes, but instead of continuing lower, price stabilizes or reverses upward. Wyckoff taught that this is one of the most powerful signals of smart money intervention, because absorbing such large volume requires institutional participation. This marks the first step in building a larger bullish structure. The volume climax is not only a signal of trend exhaustion, it is a psychological event. The average trader reacts emotionally, believing the extreme move is truth. Wyckoff traders interpret it as deception. Wyckoff argued that the composite man thrives on creating emotional extremes, pushing prices to levels that lure in the crowd just before a reversal. The volume climax is that moment of maximum emotional imbalance, where the power shifts silently from the public to the professionals. Effective traders do not simply recognize the volume spike, they analyze the spread, closing position, context, and subsequent price action. A true climax is often followed by automatic reaction, secondary test, or sign of weakness, strength, confirming that the trend has indeed turned. When interpreted correctly, the Wyckoff volume climax becomes a roadmap for identifying the beginning of a new trend and positioning ahead of the crowd. Master this one signal, and you gain the ability to spot trend reversals with a level of confidence and clarity that most traders never achieve. The concept of composite man absorption lies at the heart of Richard Wyckoff's market philosophy, serving as the silent yet powerful mechanism that shapes every major trend. Wyckoff taught that the market behaves as if it were controlled by a single master operator. The composite man, whose goal is simple: accumulate large positions at the lowest prices possible and distribute them at the highest. Absorption is the process through which this master operator quietly collects inventory, absorbs supply, and prepares for a significant price markup, all while appearing invisible to the average trader. Understanding this process is crucial because it allows traders to detect the early stages of institutional accumulation long before the explosive uptrend begins. Absorption refers to the moment when significant buying occurs within a trading range, but price does not rally aggressively. Instead, it moves sideways. This confuses inexperienced traders who wonder why huge volume doesn't produce immediate upward movement. But to Wyckoff, this is the clearest signal that smart money is at work. They are absorbing all available supply. Every time sellers dump into the market, professionals buy. Each swing downward shows reduced selling pressure, and each rally upward shows increased strength. The key idea is that absorption consumes supply quietly so that when the markup begins, price can rise rapidly with minimal resistance. Consider a stock that has just completed a selling climax and entered a prolonged accumulation range. Retail traders see boring sideways action, but the composite man sees opportunity. During this range, large institutions enter the market gradually because they cannot buy huge volumes at once without driving price higher. They rely on patience and precision. Wyckoff explained that the composite man prefers to operate where the crowd is disinterested. Absorption often takes place when retail traders have left the market out of frustration, creating the perfect environment for professionals to accumulate in bulk. The hallmark of absorption is diminishing supply demonstrated by price behavior. Downward swings become narrower, volume on declines weakens, and tests of support fail to break previous lows. This tells the Wyckoff trader that sellers are running out of ammunition. Each successful test, whether a spring, a shakeout, or a minor pullback, indicates that sell orders are being soaked up by powerful buyers. By the time absorption is complete, the composite man holds the majority of shares and sell-side pressure is nearly depleted. What follows is the sign of strength, SEO, the moment the market breaks out with convincing volume and wide spreads because there are no sellers left to counter the buying pressure. This phase transition confirms that absorption is finished and the markup is ready to begin. Traders who identify absorption early can position themselves before the crowd, catching the initial breakout and riding the trend with confidence. Composite man absorption is not just a technical concept. It is a psychological one. While the public sees sideways movement and assumes nothing is happening, professionals are executing their most important work. Wyckoff taught that the ability to read this quiet accumulation process separates losing traders from strategic, informed ones. Once you understand absorption, you stop chasing breakouts blindly and instead position alongside the true market operator, the composite man himself. A supply-demand imbalance is the foundational principle behind every price movement, reversal, and trend continuation within the Wyckoff method. Wyckoff emphasized that price does not move because of indicators, news, or luck. It moves because of a fundamental shift in the relationship between buyers' demand and sellers' supply. When demand exceeds supply, price must rise. When supply overwhelms demand, price must fall. But the brilliance of Wyckoff's approach lies not in knowing that this imbalance exists, but in learning how to detect it early, before a major move unfolds. Understanding this one concept allows traders to predict huge price shifts with far more accuracy than any lagging indicator ever could. A supply-demand imbalance often begins subtly. Many traders expect huge candlesticks or dramatic volume spikes, but Wyckoff taught that the earliest clues are found in the nuances of price behavior: narrow spreads, weakening rallies, failure to hold lows, or a sudden inability to break resistance. These are not random events, they are signals that one side of the market is losing influence while the other is quietly gaining control. For example, if a stock is falling and volume is decreasing on each decline, this indicates that supply is drying up. Sellers are becoming exhausted. When demand eventually steps in, even modest buying pressure can ignite a sharp reversal upward. This shift happens not because something magical occurred, but because supply was no longer strong enough to resist incoming buy orders. Similarly, when a market is rising but volume on each rally weakens and candles show long upper wicks, Wyckoff would interpret this as hidden supply entering the market. The composite man is unloading inventory into public enthusiasm. The public sees a bullish trend, Wyckoff sees distribution. This is where most traders get trapped. They believe the trend is strong because price is rising, but they fail to observe that demand is weakening while supply is secretly increasing. Eventually, the imbalance becomes obvious. Price stops advancing, breaks support, and cascades downward as the composite man finishes distributing. To the untrained eye, this looks like a sudden sell-off. To a Wyckoff trader, it was predictable. One of the most powerful ways to identify a supply-demand imbalance is through volume spread analysis, VSA, which Wyckoff pioneered long before it became popular. A wide spread on high volume with little price progress signals the presence of strong opposing pressure. For instance, a wide down bar on heavy volume with a close off the lows indicates that strong demand absorbed the selling. Conversely, a wide up bar on heavy volume with a weak close shows that heavy selling overwhelmed the buying. In both cases, the imbalance reveals the true intentions of smart money. Retail traders see candles, Wyckoff traders see battles. These imbalances form the backbone of all Wyckoff structures. Accumulation, distribution, markup, and markdown. Accumulation represents demand overpowering supply. Distribution shows supply overcoming demand. The transitions between these phases are defined by imbalances, not random volatility. When you master this concept, you no longer chase price. You interpret its internal energy. You begin to see where the market is likely to move next, not because of prediction, but because you understand the invisible tug of war behind every candle. A supply-demand imbalance isn't just a technical signal, it's the heartbeat of the market. And when you learn to read it, you gain the ability to anticipate major price shifts with the same clarity Richard Wyckoff used to outmaneuver the crowd. Smart money accumulation is one of the most transformative concepts in the entire Wyckoff methodology because it uncovers a truth that most traders never realize. The biggest trends in the market begin in silence. Long before the public sees a breakout, long before indicators flash, buy, and long before social media becomes excited about a chart, the composite man's smart money has already built a massive position. Accumulation is their battlefield, their playground, and their hidden workshop. Understanding how smart money accumulates is the key to catching explosive moves early, exiting before the crowd, and aligning yourself with the traders who actually move the market. Wyckoff viewed accumulation as a deliberate, strategic phase in which large operators quietly absorb supply after a downtrend or selling climax. Unlike retail traders, smart money cannot buy millions of shares at once. Doing so would push price upward and expose their intentions. Instead, they accumulate slowly, methodically, and intelligently. They operate within a trading range where price oscillates between support and resistance, a zone the public often calls boring, sideways, or choppy. But to Wyckoff traders, this sideways structure is the birthplace of the next major bull trend. Every dip is tested, every rally is measured, and every increase in volume is evaluated to ensure that supply is drying up. A key characteristic of smart money accumulation is controlled volatility. The Composite Man allows price to fall just enough to provoke sellers into releasing their shares, but not enough to break the structure. These shakeouts, springs, and tests are engineered traps designed to force weak hands out of the market while the professionals quietly buy from them. To retail traders, these moves look like manipulation. To Wyckoff practitioners, they are confirmation that smart money is active and absorbing supply aggressively. Volume behavior during accumulation tells a compelling story. Early in the phase, down bars often appear with high volume, indicating that sellers are still present. But as the range continues, volume on declines diminishes. This is one of Wyckoff's most important clues. Lower volume on downswing signals that supply is weakening. Buyers no longer face significant resistance, and each test of support shows less selling than the last. Meanwhile, rallies begin to show stronger price spreads and healthier demand. This subtle shift marks the transition from accumulation to preparation for markup. When smart money has absorbed the majority of available supply, they orchestrate the sign of strength, SEO-optimized, a decisive rally through resistance with strong spread and volume. This is the moment the public finally notices the move. Analysts begin calling the stock bullish, influencers start posting charts, and retail traders rush in. But by then, smart money has already positioned themselves perfectly. They don't chase the breakout, they cause it. Understanding smart money accumulation empowers traders to think like market operators rather than market victims. Instead of reacting emotionally to sideways movement, Wyckoff traders study the structure, the tests, volume patterns, support, resistance behavior, and the quiet clues that the Composite Man leaves behind. Accumulation is not random consolidation. It's preparation, planning, and precision. Once you master the ability to recognize it, you hold the key to entering early, managing risk intelligently, and capturing the beginning of powerful trends that most traders only dream of catching. Volume-Price Divergence is one of the most revealing signals in the Wyckoff methodology because it exposes the moments when the market's story price contradicts its truth. Wyckoff taught that while price can be manipulated to mislead the public, volume exposes the intentions of smart money with remarkable clarity. When price and volume begin to diverge, moving in opposite directions, it is a strong indication that the Composite Man is either entering or exiting a position quietly, setting the stage for a major reversal or continuation. To Wyckoff traders, divergence is never an accident. It is a message from the market telling you to pay attention. In a healthy uptrend, price rises on increasing volume, indicating strong demand. But when price continues rising while volume declines, Wyckoff would immediately recognize danger. This means each rally is supported by less enthusiasm and fewer buyers. The trend may look bullish visually, but the internal energy behind it is weakening. In many cases, this is the early stage of distribution where smart money is selling into the public's late buying. To unsuspecting traders, the price rise looks like strength. But Wyckoff analysts see the truth: demand is weakening and supply is quietly increasing. When this divergence persists, it is only a matter of time before price collapses, catching the public off guard. On the other side, during a downtrend, price typically falls with increasing volume, reflecting strong selling pressure. However, when price continues to decline but volume shrinks, Wyckoff interprets this as a critical moment. The selling pressure is fading. Despite price drifting lower, smart money is no longer participating in the move. The Composite Man may even be absorbing shares from panicked sellers. This type of divergence is a classic precursor to accumulation, signaling that the downtrend may be nearing exhaustion. Retail traders see defeat. Wyckoff traders see opportunity. One of the most powerful forms of volume, price divergence, occurs when price makes a new low, but volume is significantly lower than the previous decline. Wyckoff called this a test. It reveals that supply is nearly gone. There simply aren't enough sellers left to push price down aggressively. After this, even a modest influx of buying can spark a strong upward reversal. Conversely, when price makes a new high on weaker volume, it signals that demand is tapering off and buyers are losing control. This is often the final rally before a major markdown. Volume-price divergence also guides traders during trading ranges. During accumulation, rallies on strong volume, followed by pullbacks on weak volume, confirm that demand is gaining dominance. During distribution, declines on strong volume with weak volume rallies expose the presence of hidden supply. In both contexts, divergence reveals whether smart money is preparing for markup or markdown. The beauty of volume-price divergence is that it cuts through noise and eliminates guesswork. While indicators lag and news misleads, divergence gives traders a direct view into the imbalance between supply and demand. Wyckoff taught that when price says one thing but volume says another, always trust volume. It is the Composite Man's signature. Mastering this signal gives traders the ability to anticipate major reversals and avoid buying into weakness or selling into strength. Understanding divergence means you no longer trade what the crowd sees. You trade what the market means. In closing, remember this: the market is not a battlefield of randomness. It is a carefully orchestrated arena where smart money moves with intention, patience, and precision. Richard Wyckoff spent his life decoding these movements, revealing that price and volume are not just data points, but the fingerprints of the Composite Man guiding every major trend. Whether it's the explosive signal of a volume climax, the quiet strength of Composite Man absorption, the subtle shifts in supply, demand imbalance, the masterful patience of smart money accumulation, or the undeniable truth told by volume-price divergence, each principle brings you one step closer to seeing the market the way professionals see it. Most traders lose because they react to the surface. Wyckoff traders win because they read the underlying behavior. When you learn to interpret these signals, you stop chasing the market and start understanding it. You trade with intention, not emotion. And you position yourself alongside the only force that truly moves prices: smart money. Master these Wyckoff principles, and you don't just improve your trading, you transform it forever.